Hello and welcome back. You're watching Passive Pulse series where we discuss passive funds and ETFs. Equity markets are witnessing corrections, sparking concerns among investors, and everybody is looking for diversified asset allocation. So today we're going to talk about portfolio strategy and asset allocation. So let's begin the journey into the world of passive investing with the Passive Pulse. And joining me now is Mr. Arun Sundaresan. He's head ETF at Nippon India Mutual Fund. Welcome to the show, Mr. Sundaresan.
Thank you, Geetu. Thanks for having me on the show.
So asset allocation is the talk of the town because when equities don't perform, we look at the other assets. But otherwise, it should not be like that. We should have a well-diversified portfolio from the beginning as such. Asset allocation has been a focus recently. How does this asset allocation impact portfolio returns and help you manage your risk?
So the current context of the market, investors can relate quite well. That right now, as we speak, the equity markets are almost flat, and some parts of the market, one-year return is even negative, depending on which parts of the market you're talking about. Mm-hmm. On the other hand, if you look at commodities like gold and silver, they're almost up by 30% on a one-year basis. So if you did not make asset allocation, like for example, if all your money was only in equity, your entire portfolio would be down. And if you were in a situation where you had to redeem some money for whatever purpose, even if it is 20%, you'll be really worried that I invested so much. Now, after a year, that I'm booking losses and I had to forcibly take out money, my actual investments has gone down. On the other hand, if you're done asset allocation, suppose you're invested some money in equity, you put some money in gold, you put some money in fixed income, your portfolio instead of looking probably 0 or -%, probably could be showing whatever 7, 8, 9% kind of return. And within that, either the complete portfolio, that return is good for the entire portfolio, or within that a particular asset class is looking good. You will not regret to redeem. So that's how the asset allocation helps. So you need to make investments into different asset class, again depending on your investment horizon and different requirements. Having different exposure to different asset class can give you balance and all this flexibility to redeem and to plan your investments in your entire journey.
What are the common mistakes that investors make in asset allocation? It's always that when the markets are in downturn or in correction mode, then only we remember that we have to diversify our portfolio. So what are the common mistakes that they make?
The common mistake is overexposure to a particular asset class. So it could be entirely equity or only in fixed deposits and so on and so forth. So that could be one. Second is not aligning their portfolio with their investment objectives. Suppose, within your investment objectives, there could be different sub goals, right? You might need money for the next 1 year for some purpose. Some money could be deployed for the really long term. It could be for growth potential. Some part of your portfolio you will need income from on a regular basis. So if you don't consider all of them and if you don't make investments accordingly, then your overall investment objectives are not going to be met. So these two things will have to be kept in mind to have a diversified portfolio and to ensure that your different sub goals and objectives are met along the way.
How do passive funds improve diversification across sectors and geographies?
So see, passive funds again come in different formats. So you have equity funds, then you have fixed income passive funds as well. Like you have index funds, again, there are a lot of variety within that. Then even gold and silver are considered to be passive investments because there is no active call as to when to invest and stuff like that. So you have three different asset classes: equity, fixed income, and commodity, and within that gold and silver. All of them are quite different. Even between gold and silver, the reaction, they can be considered to be different asset classes. The way they react, their characteristics are very, very different. And within each of these asset classes, like for example, in equity, you have broad-based indices, you have sector, you have thematic, you have strategy indices. Some of them could be relatively aggressive strategies. Some of them could be relatively defensive. Likewise, in fixed income, you have portfolios which can give you exposure to only government securities. There are corporate bonds, combinations, different maturities. So you can create different risk return profiles with this, and whatever is your requirement by investing into these asset classes and combination of asset classes. So within passive itself, a whole lot of possibilities exist. A range of products to suit your different goals are available.
While the equities are correcting, as we all know, gold and silver is performing. They have done reasonably well in this last 1 year. So, what role do commodity ETFs like gold and silver play in diversified portfolio?
While you might assume that equity is the best and it tends to do well many more times than other asset classes, at least going by this data for the last 10 years, it's been the other way around. So to that extent, obviously, all these commodities, gold, silver, etc., have a good role to play in your portfolio. Oftentimes, when some asset class like equity is not working, having exposure in gold, silver, in your commodities will really enhance your returns, mitigate risk, and overall, kind of lend that balance and diversification to your portfolio. So depending on individual preferences, risk return appetite, investors can have various amounts of gold and silver in their portfolio.
Mr. Sundaresan, thank you so much for your time, and thank you so much for explaining us how asset allocation and diversification can help us limit our risk and create wealth in the long run.
Thank you very much.
Thank you.
An investor education and awareness initiative of Nippon India Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.